Good morning, everyone. Good morning, Rick.
Good morning.
Doing okay?
Doing great.
Okay, great. I call this meeting of the NCUA Board to order. The first item on our agenda today is Share Insurance Fund Quarterly Report. Staff presenting Rendell Jones, Chief Financial Officer. Good morning, Rendell.
Good morning. I'm here to present the 2018 fourth quarter statistics for the Share Insurance Fund. Our external auditors have completed the financial statement audit of the Share Insurance Fund for the year ended December 31st, 2018. The fund received an unmodified or clean opinion on the presentation of its financial statements with no reportable conditions. That is also true for the audits of the operating fund, the Community Development Revolving Loan Fund, and the Central Liquidity Facility. The year-end audited statements were posted to NCUA's website last month. In addition to my own team, people throughout the agency worked on year-end financial reporting and the audit process, and I want to extend my thanks for everyone's contributions. Looking at the first slide, revenues and expenses. This table shows the Share Insurance Fund's revenues and expenses for the fourth quarter of 2018. For the quarter ended December 31st, 2018, the fund recorded net income of $67.3 million. Total income of $78.5 million consists primarily of investment income from Treasury securities of $74.3 million. Additional income sources include $4 million collected for guarantee fees on the NCUA guaranteed notes, or NGNs, and about $200,000 of other income from interest on the building note and insurance exam fees. Operating expenses were $45.7 million for the quarter. The provision for insurance losses increased by $3 million during the quarter. The specific reserve remained unchanged for the quarter, while the general reserve increased $3 million. I'll discuss changes in the provision for insurance losses on slide 15. The Natural Person Credit Union Asset Management Estate loss expense shows a reduction of $24.5 million. And the reduction represents recoveries realized by certain asset management estates. The corporate asset management estate loss expense decreased $13 million due primarily to favorable changes in the estimated future cash flows of the legacy assets in the NGN program. The next table shows the Share Insurance Fund's balance sheet as of December 31st, 2018, compared to the previous year-end balance sheet. For the year ended December 31st, 2018, the Share Insurance Fund's total assets are valued at $15.8 billion, of which about 95.1% of assets are funds held with the U.S. Treasury in cash, overnight investments, and Treasury notes. Overall, total assets decreased $825.1 million, or about 4.9%, due largely to a decrease in funds held with the U.S. Treasury associated with the $735.7 million dividend paid last July. The receivable from the Natural Person Credit Union Asset Management Estates is $408.9 million, which increased about $400 million, primarily due to a net of $1.1 billion paid for insurance claims, offset by asset management estate recoveries and a $726.6 million allowance adjustment. The receivable from the corporate asset management estates is $289.3 million, which decreased about $197 million from the previous year. This decrease is primarily due to the collection of post-NGN receipts, offset by a reduction in insurance losses due to favorable changes in the estimated future cash flows of the legacy assets in the NGN program. This receivable is typically reduced by cash collections for recoveries, such as bond maturities, sale of assets from asset management estates, and recoveries through litigation. Accrued interest and other assets is $64.9 million, which increased $5.5 million, or about 8.4%, largely due to an increase in the accrued Treasury interest receivable at year-end. Total liabilities are $125.1 million, or about 0.8% of total assets. Accounts payable of $6 million primarily consists of amounts due to the NCUA operating fund for allocated administrative expenses. The Share Insurance Fund's Insurance and Guarantee Program liability or reserve will be explained in the next slide. The fund's net position is comprised of capital deposits, which represent the total balance for all federally insured credit unions' 1% capitalization deposit and cumulative results of operations. Capital deposit activity increased about $562 million for 2018. The balance of cumulative results of operations decreased by a net of $577 million during 2018 due to the previously mentioned dividend and unrealized losses on investments, offset by net income, as I explained on the revenue and expenses slide. Next, turning to slide 5, the Share Insurance Fund's insurance and program guarantee liabilities, or reserves. SIF reserves decreased in the third quarter from $156.2 million to about $119.1 million. The reserve expense decrease includes $3 million, an increase of $3 million for anticipated losses related to the general reserve. And there was no change in the specific reserve during the fourth quarter. Each year, NCUA assesses the specific reserve needs for potential credit union failures when the loss is probable and estimable. In addition, the Share Insurance Fund paid about $600,000 for the cost of liquidations and about $39.5 million for an assisted merger during the quarter. The reserves at quarter end totaled about $119.1 million, with $7.3 million for specific reserves and $111.8 million for general reserves. Next, turning to the Share Insurance Fund portfolio. As of December 31st, 2018, the Share Insurance Fund had $15.2 billion at par value invested in Treasury securities with maturities out to February 2026. The weighted average life of securities held by the Share Insurance Fund is approximately 2.4 years, and the weighted average yield of securities held by the Share Insurance Fund is 2.01%. Last night, we invested about $1.3 billion at a rate of 243 basis points, earning about $88,000. The second bar chart shows a cumulative picture of how much of the portfolio will mature over time. About 89% of the portfolio will mature over the next 5 years. During the fourth quarter of 2018, 5 Treasury notes matured in the amount of about $750 million. These securities had yields ranging from 0.83% to 1.7%. The Share Insurance Fund purchased 9 Treasury notes during the fourth quarter, totaling $1.7 billion, which had yields ranging from 2.49% to 2.87%. Next, turning to the equity ratio chart, the current equity ratio as of year-end is 1.39%. The ratio is based on an insured share base of $1.1 trillion at December 31st, 2018. In addition, the blue line on the chart represents the normal operating level, currently set at 1.38%. Turning to slide 8, the number of Camel Code 4 and 5 credit unions decreased by a net of 10 during the fourth quarter of 2018 for a total of 193. Of these credit unions, 85% have less than 100 million in shares. Approximately 13% have more than 100 million in shares, but less than 500 million in shares, and the remaining 2% have more than 500 million in total shares. Total shares represented by credit unions that are Camel Code 4 or 5 is $10.6 billion, or about 0.93% of all insured shares. There's a 2 basis point increase compared to the ratio at the end of the last quarter. Comparing Camel Code 4 and 5 by asset size from September 2018 to December 2018 shows that credit unions with assets less than $10 million and assets greater than $10 million but less than $100 million both decreased. Credit unions with total assets between $100 million and $500 million increased. There was no change in total asset size for credit unions over $500 million. During the quarter, Camel Code 4 and 5 total shares increased $0.2 billion or 1.9% to $10.6 billion, and total assets increased $0.3 billion to 2.6% to a total of $11.8 billion. Next on slide 10, the number of Camel Code 3 credit unions decreased by a net of 61 during the fourth quarter of 2018 for a total of 940. Of these credit unions, 89% have less than 100 million in total shares, 9% have between 100 million and 500 million in total shares, and 2% of these credit unions have more than 500 million in total shares. As of December 31st, 2018, total shares in Camel Code 3 credit unions was $45.6 billion. This is a $3.3 billion or 6.8% decrease from last quarter. Camel Code 3 credit unions represent 3.99% of total insured shares at the end of the fourth quarter of 2018, which is a decrease of about 33 basis points from 4.32% at the end of the last quarter. Comparing Camel Code 3 by asset size from September 2018 to December 2018 shows the total number of credit unions decrease. However, there was a small increase in the number of credit unions above $1 billion in total assets. Camel Code 3 total shares decreased by a net of $3.3 billion or 6.8%, and total assets decreased by $3.2 billion or 5.7%. On slide 12, this slide shows the distribution of assets by Camel Code. The red portion of the chart is the percentage of total credit union assets that are Camel Code 4 and 5, and the green represents the percentage that is Camel Code 3, while the blue represents the percentage of credit unions that are Camel Coded 1 or 2. The distribution of assets over the last quarter increased about 0.3% for Camel Code 1 and 2 credit unions and decreased about 0.3% for Camel Code 3 credit unions. Assets for Camel Codes 4 and 5 credit unions did not change. Next on slide 13, turning to the number of credit union failures in 2018. In 2018, there were 8 credit union failures. Of the 2 failures during the fourth quarter, 1 was an involuntary liquidation with a purchase and assumption agreement, and 1 was an assisted merger. Year-to-date, the cost of failures for 2018 was $792.5 million. For all of 2017, there were 10 failures, 5 of which were involuntary liquidations with a purchase and assumption agreement, and 5 were assisted mergers. The cost of failures in 2017 was $24.4 million. Fraud was a contributing factor to 2 of the 8 failures in 2018, making up about 0.04% of year-to-date losses. In comparison, fraud contributed to 3 of the 10 failures in 2017, costing about $23.2 million of the $24 million, or about 95% of total losses for 2017. This concludes my presentation. I'll be happy to answer any questions you have.
Thank you, Rendell. You go to page 3. Investment income, so shows year to date 12/31/18, $284 million. As I recall, if I'm recalling correctly, last year it was a much smaller number.
Yes, that is correct.
And that's just principally due to increases in interest rate.
Yes.
Okay. The going down that slide where it says AME loss expense reduction, you have brackets around 26.3. Did you say that's because recoveries exceeded prior reserves?
Yes, principally that is right. We also estimate the reserve each quarter as to what still needs to be included as a liability on the balance sheet. That's one. And secondly, we also evaluate any changes to the allowance on the receivable from asset management estates. Movements in those 2 numbers will also cause a negative expense there, but
Okay.
collections also.
So negative expense, that's the opposite of an expense, what really adds to the bottom line.
Correct.
Right, by 26.3, because prior time period, we had taken a reserve that was an expense that decreased income. Now we're reversing that.
That's correct. It's reversing a prior charge to the fund.
On the next page, 4, as of December 31, 2018, under notes receivable net, it's 6.4. Could you explain that again?
Yes. So notes receivable net is principally the outstanding note on the NCUA central office building. When the original construction for the building happened, there was a note from the share insurance fund to the operating fund, and that is the balance principally that's remaining on the outstanding note.
Okay, thank you. So on slide 6, it shows that we have a weighted average life of about 2.4 years, weighted average yield of about 2%. So as interest rates have risen over the last 2 years, and with a weighted average life of 2.4 years, is our portfolio staggered in a way to help mitigate any interest rate risk built in this?
So principally, the investment strategy for the fund focuses on safety first. Obviously, we can only invest in investments that are backed by the full faith and credit of the U.S. government. The second is liquidity. So this is the principal investment goal, and then yield. But the portfolio is shorter than it used to be, and the weighted average yield has also improved with improvements in interest rates. And in the statistics that I read earlier, so the maturities in the fourth quarter, those had yields ranging from 0.83% to 1.7%, but our new investments have yields ranging from 2.49% to 2.87%. So there clearly has been improvement because of improvements in the Treasury security market.
Okay, so the weighted average yield, as I recall, a couple of years ago, the investment committee took it down because of the need for more liquidity.
That's correct.
So we wouldn't be forced in effect to sell securities. It's had the additional benefit, since interest rates did go up, of having a shorter weighted average life and less interest rate risk built into it.
That's right.
Okay. Page 7. Okay, so here, when we merge the stabilization fund into the share insurance fund, we set the normal operating level at 1.39. And last year we went through and redid the analysis by looking at the Federal Reserve Board of Governors analysis, how it applies to the share insurance fund. We looked at BlackRock. We looked at the same metrics, and we determined that we could reduce the normal operating level to 1.38%. It just so happens that the equity ratio came in at 1.39, which means that if the equity ratio is greater than the normal operating level, the difference has to be paid out as a distribution, and that's what we declared last week. Is that a fair statement?
Yes, it is generally a fair statement. The one thing I'd add to your comments is that the board has a few other options as to what to do with capital above the normal operating level. It could be a rebate of future premiums. There are a few other options in the statute, but generally distribution is right.
Okay, but we felt it was prudent to be able to pay the dividend.
Yes.
Okay, thank you. Let's see. I think that may be. That's it for me, Mr. Metz.
I have no questions.
Thank you, Mr. Jones. Appreciate it. Second item on our agenda is final rule, Part 701, loans to members, staff presenting Frank Cressman, Deputy General Counsel, and Tom Zels, Staff Attorney, Office of the General Counsel. Good morning, gentlemen.
Good morning. We're here today to present a final rule to make technical and clarifying amendments to Part 701 of our regulations regarding loans to members. Specifically, we're addressing loan maturities and borrower limits in this context. These final amendments are based on recommendations made by the NCUA's Regulatory Reform Task Force, and they're intended to reduce regulatory burden by clarifying the rule and making it easier to comply with. Tom will provide you the details of the final amendments and also touch on the proposal that preceded this rule.
Thanks, Frank. The NCUA published the proposed rule and request for comment in August 2018. The rule proposed 3 technical and clarifying changes to improve clarity and make compliance easier. Commenters were overwhelmingly supportive of the technical and clarifying changes that the proposal made. The proposal also sought advanced comment on several related issues. Commenters provided good feedback on these issues, and we will continue to evaluate the issues and the comments received moving forward. In terms of the final rule adopts the 3 changes we recommended in the proposal as proposed. To summarize, the final rule first identifies all of the various maturity limits applicable to different types of FCU loans in one paragraph. Second, the final rule clarifies that the maximum maturity for a lending action that qualifies as a new loan under generally accepted accounting principles is calculated from the new date of origination. Finally, the final rule also more clearly expresses the limits in place for loans to a single borrower or group of associated borrowers by including cross citations in the general lending limit section of our regulations to the more specific loan participation and commercial loan limits in those respective regulations. With that, we'll be happy to answer any questions you have.
Okay, I have no questions. I think this is exactly the type of cleanup rule that we should be promulgating. We'll make it much more easier. We'll make it easier for someone who's new to this area to see what all of the law is in one section, as opposed to thinking they see it, but not realizing that 100 pages later, there's something else that's relevant. Let's put it all together. It's all transparent wherever it is, but if it's all together, it makes it much easier to work with. Mr. Metzger?
I don't have any questions. Thank you.
Okay, is there a motion?
Yes. I move the board approve final rule part 701 of NCUA's rules and regulations as attached to the board action memorandum.
I second the motion. All in favor say aye.
Aye.
Aye. Let the record show the motion passes 2-0. That's the end of our agenda today. There being no further business, we are hereby adjourned. Thank you.